A crime boss, let's call him Ivan, has made a fortune from international cocaine deals. He wants to make it look like the money came from a legitimate source, so he can freely spend it. Ivan establishes a shell company in Latvia that claims to own a chain of coffee shops, and another company in Dubai that pretends to supply coffee beans. He opens an account for each company at regional banks. He knows they won't ask too many questions. The Dubai company invoices the bogus coffee shops for $600,000 worth of beans. The two regional banks can't directly transact with each other. Each has an account with a US-based correspondent bank, intermediaries that allow banks across the globe to process payments in US dollars. The big banks help process the dollar payments for the fake beans. US banks move trillions for regional banks around the world each day. Most of the time, they simply zip the money along to its final destination. But the bank handling Ivan's transfer flags it as suspicious. It may decide to A. Freeze or reverse the transaction and return the transfer fee, or B. Report the transfer as suspicious to US regulators, send the money to Dubai, and collect the fee. The US bank handling Ivan's payment sent the cash and then told US authorities about it. Option B appears to be very popular. In 2019, US financial institutions filed more than 2 million suspicious activity reports. Failure to file a SAR can expose banks to fines or penalties. BuzzFeed News and ICIJ's FinCEN Files investigation found that big banks cleared more than $2 trillion in transactions that they later flagged as suspicious. As a rule, they always took a fee.